We're just waiting for a few more to join us, and then we'll start. We'll just give it a couple of minutes. Just wait another minute or so. I think people are joining us as it's just gone 12. Just a few more seconds and we'll start. People joining. Right, let's make a start then. Well, good afternoon, everybody, and welcome to our LBV webinar. I'm Mukesh Balsara, Director at Leicestershire Business Voice, and I'm delighted to welcome you all to what always proves to be a very popular presentation. Our focus today will be on the state of the economy, and we are joined by Rosie Smith, East Midlands representative for the Bank of England. Now, Rosie joined the Bank of England in 1986 and has worked in areas including banking supervision, financial stability, statistics and economics before being deputy agent and agent for the Bank of England in the East Midlands. Rosie has a BSc in Financial Economics from Birkbeck, the University of London, and an MBA from the University of Nottingham. Rosie resides in Leicestershire and has been a good friend and supporter of Leicestershire Business Voice. And many of you will have had the pleasure of hearing Rosie speak at previous LBV seminars. We hope today will be interactive, and we will be posting polling questions throughout the session. Please do post your responses, which we will share. There will also be an opportunity for questions at the end, but please do post your questions throughout the webinar. In the control panel, there is a question box, so if you think of a question that you'd like Rosie to answer, please pop that in the question box. We're aiming for a 1 p.m. close, so without further ado, I will pass on to Rosie, who will share with us her valuable insights into the state of the economy. Thank you, Rosie.
Thank you, Mukesh, for that lovely introduction, very comprehensive introduction. So the only thing I can add to it is to say that my job is to not only to talk as I'm doing today, but more to listen, to understand the economy from the likes of people like you. So I look forward to the question and answer session and any thoughts you might have on your experiences of the economy as well. So whilst I can't see you, I'm trying to perceive that you're out there, and I'm very interested in hearing what you have to say. So first slide, please. Thank you. This is what I'm going to talk about today. So I'm going to run through the key metrics in our economy, how it's recovering from the pandemic, prices, jobs, how we set policy, and then, as I say, over to you. It won't take more than, I won't speak for more than about 20 minutes on this, to give you plenty of time to come back. Okay, first slide, next slide, please. Right. This is my favourite slide that I'm going to put up today, started with the best one. I find this slide extremely cheering. It confirms that the vaccination programme in the UK is proceeding at a rapid pace. Particularly like this slide because I'm on one of the later bars on this slide. Delighted to have had my vaccine last week. Looking forward to everyone else I know getting theirs soon. But as to say, the difference it's made to my own mood, my confidence, the way I look forward has been quite huge for me. And if you extrapolate that across the other 60 million people or so in the UK economy, that suggests that as this chart keeps going up, the more confident we're all going to feel and the happier we're going to feel. Now that's important because it influences how much money we spend in our economy, consumer spending, and ultimately growth in our economy. So I'm going to start by talking a bit about consumer spending. Next slide, please. Now, this chart shows you the changes in spending due to COVID restrictions. Now, spending in the UK economy has held up better than a lot of people feared during the pandemic, but it has changed. The way people spend their money has changed because, of course, restrictions mean that you can't spend money on some of the stuff you used to, like restaurants and recreation. You need different sorts of things like fewer business suits, wedding outfits and so on, and more loungewear on the clothing side, and you buy things in different ways. So we've seen much more shopping going online. These are quite big numbers, they're quite big shifts. It doesn't sound like a lot of money you think in terms of pounds per week, but those are big changes. So the question for us looking forward and thinking about consumer spending and what it means for growth is, will that sort of some of that shift continue? I think particularly we're expecting online spending to continue to be stronger. It was a change we were already seeing pre-pandemic, but it seems to have accelerated and it's definitely moving in that direction. Next slide, please. Thank you. So overall in the economy, we have, as I mentioned, saved money as consumers during the pandemic. We reckon that between March and November last year, excess savings have totaled around about £125 billion in our economy. Since then, you could probably add another 25 or more. So we're talking about roughly 150 billion pounds of excess savings that people have. Now, are they going to spend this money? Is one of the big questions that we're asking at the moment. in understanding what the answer to that question, we need to think about who's actually got this extra money, and this chart shows you that. So people that have increased their savings in the red bars, people that have decreased them in the blue bars. And what this chart shows you is that typically the people that have increased their savings have been those that are either high income or middle income or retirees. Now, these are precisely the sorts of people who don't tend to spend any extra money they have, or not very much of any extra money they have. They're more inclined to save it. In other words, they have a lower marginal propensity to consume. So the people that the people that are more likely to spend extra money they have had less money to spend. We've therefore made the conservative estimate that something like 5% of these excess savings will be spent in the coming few months as restrictions lift. Now, that doesn't sound like very much, 5%, but it is a fair amount. It's about £7 billion or so of extra spending that will come into our economy in the coming few months. So that's consumer spending. Next slide, please. This is a business investment, which is another important part of economic growth. Now, this chart here is a long one chart going back 20 years or so. And what it shows you at first glance is that business investment has been very weak since 2017 and weak compared with previous years since 2000. In fact, it's been flat on average over that time, and that's because of uncertainty around Brexit. We didn't see this sort of pattern in other countries, other big rich countries. We only really saw it in the UK. So it suggests uncertainty has been a big influence on investment. And of course, something like a pandemic increases the amount of uncertainty in an economy. So all we're hearing is that investment has been weaker this year. That line would go below the 0% line. And companies are telling us that they just haven't got the confidence to invest. Now, there's a bit of noise in the background. Could everyone mute, please? Thanks. So we need investment in our economy. We need it for economic growth because it's part of that. We need it to support transition to net zero at the moment, and we need it to support a more digitized economy. Companies will need to spend on these things, government will need to spend on these things to get us where we need to get to stay strong and create jobs going forward. Now, the bank can do a bit to encourage that by keeping the cost of borrowing low, which is one of the reasons why interest rates is low. The government, of course, are also keen to drive the investment, encourage companies to invest, which is one of the reasons why changes in the budget on capital allowances were brought in. Now, that takes us on to the next slide, which I think is a poll. Here we go.
It is. Thank you. So our first polling question for everyone is what Rosie just touched on. Have the investment incentives announced in the budget made it more likely that you or your clients will make investments in capital equipment in the coming 2 years? So if you could answer yes, a lot, or yes, a little, no, or not applicable. We'll give you a few seconds to place your vote, and we'll see what the results throw up. Ooh. So we've got yes, a lot, 6%, but the well, yes, 41%. If you have the 6%, that's a yes, so 47, and then only 6% are saying no, and not applicable, 47%. What do you make of that then, Rosie?
So I think I would tend to be a half glass full person on this and say that if you had the yes a little and yes a lot together, then that's almost half of people. I'm conscious that the audience is such that this isn't necessarily applicable to everyone because this is about capital equipment. So yeah, I'm encouraged by that, I think. I'm not here to flag way for the government, but that is a good sign in terms of people actually actively thinking about investment.
Great.
Thank you. Right, so the last element of growth I wanted to cover today is trade. I'm going to just give you, I'm going to pause so you can read this slide. So just to summarise for anyone who can't see that slide, the trade deal that was agreed on Christmas Eve was very similar to what we thought in our forecasts. I got our assumptions right on that, and so it didn't shift a lot of what we were feeding into policy on trade. But we do think that Brexit and the frictions around it, so things like delays at borders and extra paperwork, will reduce trade and therefore reduce gross domestic product, in other words, growth in the first quarter of this year. Okay, next slide, please. This is our official projection for growth in our economy, so gross domestic product. Now, some of you won't have seen this chart before, so let me just pause to briefly explain how this works. We don't have point forecasts as such for economic variables because of the degree of uncertainty involved in predicting anything, particularly at the moment. So what we produce instead is a fan chart, which gives you a range of possibilities. So this gives you, as you can see, there's sort of various different shades of green. The most likely outcomes are shown in the darker green, and so on further out to the lighter outcomes. So what this chart is telling you is that in the past, which is the area to the left of the dotted line, our economy was growing quite slowly but quite nicely up until the COVID pandemic hit. It fell back strongly last year. We lost about 10% of our economy last year altogether. We had a pick up in the third quarter, a flattish growth in the fourth quarter. We've seen another drop in growth in the current quarter, first quarter of 2021. But we think that as restrictions in the economy ease, that demand will start to pick up again, quite steeply. So that's, as some people might describe that as a bit of a Nike swoosh, I think. And it gets us back onto a path where we were that looks more normal. We think that the level of output in our economy will get back to where it was pre-crisis by about the first quarter of next year. Right, next slide, please. Another poll.
So, what Rosie's just touched on again, when do you think the level of activity in your business will be back to what you consider normal? So the first option is by the end of 2021, or by the end of next year, 2022, or do you feel it will be further ahead than 2022? Or is it close to normal now? If you could please vote, and we'll see what the results show. So, quite interesting reading. The vast majority, again, glass half full, half are saying that it is close to normal now, which is really good news. Over to you, Rosie.
Thank you. Yes, that is good news. That's very encouraging. I'm talking to more and more businesses who are telling me actually things are getting close to normal now, and those that aren't are looking forward and saying it will get back to normal. Quarter view still saying by the end of 2022, so that's obviously a slower pace of growth, but still heading in the right direction, I think, is how I'd read that. So that's interesting. Thank you for that. Right, next bit of the presentation is about prices. So what's happening to prices in our economy? Now, we have a target for inflation, which is 2%, and the Monetary Policy Committee is required to get as close as it can to 2% over the medium term. Now, at the moment, CPI, which is Consumer Price Index, which is the measure we use to measure inflation, is at 0.4%. It was just announced yesterday. Now, that's very weak compared to 2%. It's weaker than a lot of people expected. But if you look at the underlying weakness in inflation, the main reason for it has been COVID. So weak demand in the economy tends to pull prices down. And in particular, we saw a big fall in the oil price because the pandemic was a global thing and it lowered the oil price. The oil price influences lots of other prices. So that weak oil prices has pulled down inflation a lot over the past year or so. Now, we think that, as this chart shows you, that inflation will start to pick up again over the next few months, and by the by the sort of summer or so, we think it'll get close to its target of 2% and stay at about 2% going forward. Now, it's not just us that thinks that. The financial markets are also expecting 2% inflation. I need to just mention here that we're hearing quite a lot of concerns. I had a meeting this morning where this was very firmly said to me that there are lots of worries out there about rising raw materials prices. We're seeing prices rising in areas such as cardboard, metals, polymers, and so on. We're trying to understand what's going on there and work out to what extent that's going to affect consumer prices. It's something we're looking at, but on the basis of the information we have now, our forecast is still in line with this broader picture of a pickup in the medium term, in the short to medium term, but staying at about 2%. Right, next slide, please. And now on to jobs. Next slide, please. Right, now behind all this data, there's people with jobs and without jobs. So let's look at what's happening there. Now, counting accurately the number of people who are unemployed or employed at the moment is quite difficult, mainly because of the furlough scheme, which has distorted the labour market quite a bit, and people's definitions of whether they're employed or not. Some people on furlough are working other jobs as well, and some people are moving in and out of self-employment at the moment. So measuring it is difficult. Now, the official measure of unemployment is usually the labour force survey. The percentage of people unemployed according to labour force survey at the moment is 5%. Labour force survey in this chart is the blue line, and as you can see, if you compare it to two other key measures of employment, it's considerably stronger. So it suggests that more people are in work than other measures suggest. So I think our view would be that we think unemployment is currently higher than 5%, but actually quantifying how much higher it is quite difficult. Next slide, please. And just to back this up, this chart shows you how much redundancies picked up last year, quite a striking increase in that. And you can compare it with 2009 after the financial crisis. It was a much more extreme and steep increase in redundancies. So I'm not now going to show you a forecast of unemployment. I'm not going to do that because we had one, but it was produced in early February before the budget was announced. And actually, the increase in the deadline for the furlough scheme has meant that it seems likely that fewer people will lose their jobs than we'd originally feared. So our official forecast for unemployment as of February was that we thought it would increase to around about 7.75% at its peak. It's now looking like that number will be lower because people are being supported in their jobs on furlough, and the hope is that demand in our economy will recover quickly enough so that as the furlough scheme ends, quite a lot of those people will find they get their jobs back. I think most people's expectation, and this chimes with companies I talk to as well, is that there will be job losses at the end of the furlough scheme, that some people are already thinking that they probably won't need all the people that are on furlough, and that they don't expect demand will pick up quickly enough. So there'll be a challenge for the economy going forward to reskill those people into where there are opportunities. And I'm hearing increasingly about companies wanting to recruit people, especially for the new economy. Right, next slide, please.
Right, thank you, Rosie. The next poll question. Again, really, this will be a good one to measure, and your confidence on what you see in your business. How do you think the number of people employed by your business will change during the remainder of this year, 2021? Are you likely to increase the number of people that you take on, unchanged, decrease, or is it too uncertain to say? Right, again, this is very encouraging. Half are saying, or almost half saying, an increase, unchanged 40%, but no one is looking to decrease, which is very encouraging. Rosie?
Yes, Yes, I'm quite surprised by that one actually. It is very encouraging. It sounds like people have businesses about the right size, number of employees about the right size for what they need going forward. So and with quite a lot looking to increase. So yeah, that is very good to see. Yeah, quite surprised about that, but in a good way. Thank you. Right, the last thing I'm going to talk about is setting policy in the uncertain environment I've described to you. Um, so this is where we are on monetary policy at the moment. This is what the Monetary Policy Committee has decided to do. So we have bank rate at 0.1%. This is the interest rate from which other interest rates are set. Now that 0.1% is historically extremely low. Bank of England has been in existence since 1694, and if we look at what bank rate has been over those years, it's tended to be 5% on average. Most of us over our lifetimes will think 5% is about what we remember as well. So we cut it to emergency levels at the end of financial crisis or during the financial crisis. We didn't think that would last long. We'd be soon back towards 5%. We've ended up having to cut even more when it's come to the pandemic. So this is about as close to zero as you can imagine it being at the moment. We've also increased our amount of quantitative easing. So we have announced in November that we will buy some more gilts, some more government securities, so onto our balance sheet. That puts more money into the system and lowers the cost of borrowing as well. And we think that as of the end of this year, we'll have about £895 billion worth of government bonds and corporate bonds on the Bank of England's balance sheet, with the same amount of money in the system to help support lending and investment. Now, if there's only one thing, oh, sorry, there's one more thing I wanted to say. Thanks. There's one thing I wanted to just leave you, message I want to leave you with. You forget everything else I said. It's this third bullet, which is that the Monetary Policy Committee doesn't intend to tighten monetary policy, at least until there's clear evidence that significant progress is being made in eliminating spare capacity and achieving the 2% inflation target sustainably. Really strong message there that even if you think you see inflation picking up, that doesn't mean that we're going to do a knee-jerk reaction and say, right, inflation's gone up, we must do something straight away to tighten monetary policy and increase interest rates. We are sure that we can only do this if there's a sustainable recovery. And I just needed to flag as well on negative bank rate. I'm happy to take questions on these things as well, but I just wanted to flag this, that negative bank rate is something we are looking at, and it's something that's been discussed in the news a lot. So that means taking bank rate below zero. It's something that we need to have. Other central banks across the world have used negative interest rates to stimulate their economies. At the moment, we didn't feel we could do it because it requires banks, building societies to have the appropriate measures in place that if they put into their system a negative interest rate, their computer system doesn't crash. So we've given them until the autumn to put these changes through. So if we ever needed to use negative interest rates in future, we can. But that's not to say that in the autumn there will be negative interest rates. And it's probably worth flagging that whilst financial markets were anticipating we would cut bank rates below zero, they're now no longer anticipating that in the short term. Okay, that's all I was going to say. So I'll hand back.
Great. Well, thank you very much, Rosie. Very, very informative and interesting. We have got some questions already posted, which I'm really pleased. Please, if anyone's got questions, continue to post them and we'll get through them as many of them as we can before 1 o'clock. The first one for you, Rosie, is from Peter Small. Can you explain, with all the enormous borrowing going on, how long before no one can afford to buy any more government bonds, and what happens then? So all of this enormous borrowing going on,
yeah.
How long before no one can afford to buy any more government bonds, and what happens then?
So so if we're talking about the borrowing by the government, so they will need to, the government every time it spends will need to borrow, and it borrows by issuing government bonds. So anyone can buy government bonds. A lot of pension funds hold them. A lot of other sort of big funds invest in them, investment funds. Some of your pensions will probably be invested in them. Individuals buy government bonds, and now the central bank has been buying a lot of them as well. So to be honest, the ability of people to afford to buy them isn't really something that I would envisage would happen. There's always a lot of demand for government bonds. They tend to be issued by auction. So you say effectively, the government wants to borrow, say, £100 million. Put your bids in, and people say, well, I'll buy 10 million for, I'll give you I'll give you a discount of 3% on that, and they basically allocate the government bonds according to the prices. So, given it's an auction, the ability of people not to be able to afford to buy them, I think, isn't something you'd really envisage. The price would fall. That's how it would work, and then as a result, the interest rate on them would rise. That's what would happen. At the moment, there's enough demand out there, I think, for them. I hope that's answered your question, but if it wasn't quite right, then please type something else in.
We've got the next question comes from Chris DeLuca. How does the reduction in cash withdrawals affect the economy? You know, we all know that people are using less cash now. How does that affect the economy, Rosie?
So that's an interesting one. So as I'm sure you all know, Bank of England is the people who also issue bank notes. That's our product. We're manufacturers to that extent. And there has been a huge shift away from using cash because of the pandemic. How will it affect the economy? I think the big issues that concern us in terms of the reduction in the usage of cash are that people may be excluded financially. So there are concerns that, for example, people who like to use cash, so often older people, often people who are less financially confident, who don't want to put their money into banks, they could find it quite difficult to participate in an economy that didn't have enough cash in it. We've seen a bit of that in Scandinavia. So some of the Scandinavian countries have seen a huge crash in the amount of cash used in the years running up to the pandemic, and there were big concerns there about financial exclusion. So we need to think about how all that works. On the other hand, there's an inevitability of there being less use of cash as people have been less keen to accept cash during the pandemic. There's been increased use of other methods of expenditure. So you see more people with handheld devices, you see more people using various different platforms to transfer money electronically. So to essentially it'll affect the economy and affect consumer spending. It'll be if people feel they can't spend because they can't use cash. And I think it's our job to make sure that sort of thing never happens, that there is a way that people can still operate in the economy in a cashless or a lower cash world.
So Rosie, who will be using these new polymer £50 codebreaker notes that have just been issued?
Yeah, of course, it's a fantastic. I hope you've all seen the new note, those of you, which is what Mukesh has referred to there. We're very proud of our Alan Turing note. It's very difficult to counterfeit. Who uses it? £50 notes are not that widely used, it's true. £20 notes are the ones that people use the most. But some people do. It has been found that some people like to have £50 notes if they want to stash cash away. So you often find £50 notes under people's beds in shoeboxes and that sort of thing. I've had phone calls before saying my old aunt's died and we've gone under her bed and found all these £50 notes in shoeboxes. So people use them to hang on to money, and apparently it's not uncommon for men to have £50 notes in their wallets. They're very rarely found in women's purses, apparently. And why that is, I don't know. But yeah, they're not used a lot, and a lot of retailers don't have them. But I think for a lot of people just like to have them as a store of value, really, that's not putting it into a bank.
Great, thank you. Richard Osborne makes an observation, and I suspect he's right. He says that the poll results are reflective of perhaps a professional services biased audience that we've got this afternoon. His feeling is that we're all very busy in our sector, and you know, he's not complaining. So thanks, Richard. Chris DeLuca has got another question. Inflation target. With the apparent change in emphasis at the Fed, with With the apparent change in emphasis at the Fed, will that affect the bank's target?
So yeah, so the Federal Reserve have got a target where they, instead of having a point target of a particular spot rate of inflation, they have a target range now. So they're giving themselves a bit more headroom on inflation. Our inflation target set by the government, set by the Treasury. So it's up to our Chancellor and his team to decide what they want our target to be. It's not something that as it is obviously going to change at the Bank of England. It would just be a matter of whether the Chancellor feels that's the right thing to do. The change that has been announced on monetary policy for us is that we've got to also bear in mind the transition to net zero when we set interest rates. So not do anything to the economy that's going to choke that off. So I think that's the direction of travel for us, as opposed to any sort of move towards what the Fed is doing.
Okay, thanks, Rosie. One on Brexit. Bruce Cooper asks, can you separate the level of impact Brexit friction issues will impact the CPI forecast? So Brexit friction issues impacting the CPI forecast.
So I can't quantify anything on that specifically, but there is clearly an impact. So that Brexit could impact the forecast in a number of ways. As I mentioned earlier, we see it coming through in lower activity because there's less trade, so that impacts growth. And in a weak growth economy, that tends to be a downwards pressure on inflation. It'll also have an effect through the exchange rate. So if the pound is affected by what's happening with Brexit, that would affect inflation. That's not in our forecast because we don't actually predict what level of sterling, what the rate of sterling will be. We don't predict the exchange rate. We tend to use what the market is thinking will happen with the exchange rate in our forecast. So yeah, I think at the moment Brexit frictions on balance are going in the direction of lower growth, therefore dampening inflation. But there are concerns building, as I mentioned earlier, on raw materials, and some of that is trade frictions causing higher input costs. So that would put upwards pressure on inflation. How these two net out will be the overall impact, but I can't quantify them yet. It's wait and see, I think, really.
Well, we've got another related question on the exchange rate. Anne Ford asks, for businesses that import and export, the value of the pound is important. What is the bank's forecast for the pound?
So he said we don't forecast the value of the pound.
I thought I'd get you there.
So sorry.
Okay. Right. Ian Borley asks, do your conversations with businesses suggest that the border issues arising from Brexit are now easing? If so, are they completely, or are they still a headwind to growth? Or is there still a headwind to growth?
So they're a headwind to growth at the moment, definitely, I would say. So our border issues easing. I don't hear much of the way people saying it's getting better. Some people are saying it's getting better, but when you drill into why it's getting better, it's because they themselves are understanding the paperwork they need better. So if you're exporting for the first time, there was a lot to get your head around very, very quickly that you only found out on Christmas Eve, and the details took longer than that to come out. So issues at borders, it's difficult to tell as well exactly what's happening at borders because a lot of companies have reduced the amount of trade they've done. So we saw quite a few companies bring things forward into December, push things back as far as they could into this year where that was possible. Stocking up. I hear that destocking is now almost completed in a lot of businesses, so trade will start to recover again. But too early to say. Trade volumes, from what I hear, are not normal yet at borders. So until they get normal, we can't really tell. We are still hearing of there being shortages of freight, shortages of containers, and so on. These are not really normal circumstances that you can actually split out and say the border issues are fine now. Some way to go, I think, is still a headwind.
Okay, thank you, Rosie. If we've still got a few minutes, if people would like to pop questions in the question box. Um, we've got another one from Chris, and this is about potential Scottish independence. And he asks, should Scotland decide to go down the independence road, from the bank's point of view, how does the process of decoupling their debt from the UK actually work, and especially during a transition period? Hmm.
That is really outside my remit, I'm afraid. Sorry. I'd like to be able to try and answer that. And if we were standing drinking a pint of beer at the pub, I would try and get my head around that one. But it is outside our remit. This is an issue for Treasury, not an issue for Bank of England. Sorry, I'm going to have to duck that one.
Okay. Any more questions, please, from the audience? If you, as I said, if you could put that in the question box. Um, whilst perhaps we're waiting, Rosie, in terms of inflation and the mix, or the basket of goods, as it were, I read last month that sanitizer had suddenly popped in. Um, are you anticipating, what would you anticipate in the next 12 months to come into the mix?
Oh gosh, I don't know. This is the idea of the basket, the typical basket, what people buy. And so the idea is that when you have an inflation measure, you're measuring the cost of for actual consumers as much as you can. Now, consumers vary a lot across the piece, but what the Office for National Statistics does when it looks at inflation is to try and understand what people are buying, and then say that that's sort of the cost of that's the cost of living, which is what we're getting at here, really. So you have times like we've had where people are spending their money in very different things, and yeah, sanitizer is one of those that we're spending a lot more money on. But you see things going in and out, I think, of the basket over time anyway. It's just that the way we are spending our money has shifted so much in the past year that the statisticians, I think, have had their work cut out in trying to get this right, and they'll have something reversal to do over the next few months as well. So it's also quite interesting when you're trying to look at the level of inflation and think that that's the thing we're targeting, and are we actually comparing like with like here? So yeah, it's these are interesting times, but we'll just have to see what happens going forward. Maybe robots will be in there one day, yeah, a personal robot or something like that. But yeah, it's an interesting trend.
I've got another one.
Which path?
Uh, you touched on the negative interest rates, Rosie, and we know that Sweden, Switzerland, Japan have gone down that route. What can we learn from that, and should perhaps the UK avoid going to that negative level, uh, learning lessons from those who have?
So it is quite interesting that other people have had a go at this before us. If we ever want to do it, there is always that precedent. Um, There's a lot of debate on the Monetary Policy Committee about this. There are 9 people with different views, but I think the average view would probably be that whilst negative interest rates sounds alarming, it can be an effective tool to have a monetary policy. So what negative interest rates means isn't suddenly that you're going to get charged for having a savings account. What it means at a sort of operational level is that, to take a step back, all of the banks have accounts at the Bank of England. We are the bankers' bank, and so that they have deposits with us and they borrow money from us to help them carry on their operations. When we change interest rates, we change the amount that we pay them for their deposits with us, and also the amount we charge for them to borrow money from us. So what negative interest rates would mean would be that instead of us paying them for the deposits with us 0.1% interest, we'd be saying, if you want to hold a deposit with us, you've got to pay a fee for that. So that then changes their dynamics in their business. Would mean that then they need to reduce interest rates in their own business for across the piece, but being able to keep their own margins reasonable, and not to make sure that their depositors don't just exit. So you would possibly see, if you kept on keeping interest rates negative for a while, and as further negative you went, the banks' margins will get squeezed. It would take quite a lot for banks to say to their depositors, I'm sorry, if you want to keep a savings account with us, we'd have to charge you for it. But some banks have done that, and they've been quite surprised that actually depositors have been keeping their money with the banks, particularly businesses, because you say to a business, okay, you've got £1 million deposit, but we're going to charge you for that. Businesses tend to respond, oh, it's a pain, but I'd rather pay for that deposit than come and take all my money out and store it in the safe. So
It's back to those
thing.
£50 notes again.
It is, yeah. It is why you see loads of £50 notes going. So yeah, so the incentive on that would be that instead of holding a deposit, you spend the money in your deposit account and to invest and to buy things in the economy and put economic growth into the economy, and that would be the incentive of it.
Okay, great.
Yeah.
Thank you. We've got one here from Lewis Stringer, and he asks, is the Bank of England concerned about the level of SME indebtedness following the COVID-19 pandemic? And do you feel that high street lenders still have the ability and ambition to support recovery? So two
Right. Hello,
questions, really.
Lewis. Lewis and I actually exchanged emails earlier today, so I know him quite well. It's a good question to ask. Now, I should say this is, please, no one sort of quote me on this officially. You can say you heard somewhere the Bank of England said this, but this is not an official view. But it's something we're hearing about more and more. So the agents around the country are hearing concerns from SMEs about their ability to grow because they have this debt burden. And will they be able to get further funds from the banks to enable them to invest, for example, if they've already got quite a lot of debt? So to that extent, it feels like a headwind. It feels like a headwind for growth, but for SMEs, it's given what they're telling us. And that's where the high street lenders have the ability and ambition to support recovery. Well, the important thing here is that we are the Bank of England, the bank's regulator. So we regulate banks, building societies, insurance companies that operate in the UK, and there is an onus on them to carry on lending. We've made sure that they hold enough capital on their balance sheets so they can continue to support lending in an economy even after a big event such as a pandemic, and they have plenty of capital to do that. We've stress tested them a lot. The money's there for banks to lend, in other words, and so we want to encourage them to keep lending, and we are talking to them regularly about this. So whether they have the appetite, they certainly have the money to lend.
Okay, we've got one on inflation. Ian Borley asking, if inflation does increase above 2%, which I'm not sure in the short term, if above that 2% target, presumably this won't immediately spook the bank into increasing interest rates. How long is the bank likely to allow inflation to exceed 2%?
So it wouldn't immediately spook us, no. The important thing is what the underlying inflation rate is. So if inflation suddenly picks up for one very obvious reason, which is short-lived situation, like for example, we might see it in the near future if it's caused by a shortage of supply, because the world economy is taking a while to pick up and demand is picking up more quickly, then that's a temporary effect. So we would look through that and say, well, actually, fundamentally, there isn't something really fundamental driving inflation all the time. We think the level of interest rates is still right. So how long we would tolerate higher inflation? We would just have to keep reviewing it alongside all the other things we look at. Look at where inflation is relative to economic growth and unemployment, and not to disincentivize investment to take us to net zero. Those are the things we consider in the mix.
Okay, good. I think that's the end of the questions. Unless there's any more, I don't think there are. So we're bang on schedule. If we go on to the next slide, thanks for answering those questions, Rosie, and of course the presentation, very informative, particularly in these turbulent times. what we're keen on at Leicestershire Business Voice is really for our members to participate and ensure that they are part of the Leicester and Leicestershire Business Voice, that we can air our experiences and views to people like Rosie, as well as other important stakeholders. So what I'm giving a plug for is, for those who are in the audience who aren't members yet, please do join us. If you like today's event and you'd like to find out more about becoming a member, please visit our website at www.lbv.co.uk. Today's presentation and other links will be available to view on the website under events. And by joining LBV, you can help businesses thrive, you can voice your opinions with local and regional decision makers, and influence policy affecting our economy. Next slide, please. So before I say thanks to everyone, I'd just like to plug our next event, which is on Friday the 30th of April, end of next month, and it's titled The Business of Sport, where we have Andrea Pinchin, CEO of Leicester Tigers Rugby, and Sean Jarvis, CEO of Leicestershire County Cricket Club. Now, even if you're not sports fans, you will appreciate that those clubs and most clubs around the country have had challenging times in the last year. And so that will be a very interesting event to see how they've coped and indeed what the future holds. So please do join us, and we look forward to seeing you then. So as it's coming up to 5 to 1, I'd just like to say a few thanks to a few people. Firstly, all the audience and the participants for raising questions and supporting us. Thanks to Robin Poynton, Jane Cowley, Simon Griven, and the Sunstar team for organising this event. And of course, thanks to Rosie for your time today and presenting what is always, as I indicated at the start, a very interesting and informative webinar. Thank you, Rosie.
Thank you very much.
Thank you, everyone. Have a good day.